Hi, I'm Peter Mallouk, and welcome to Icons and Ideas. I'm here with one of the most impressive people in all of finance, Marc Rowan, the CEO of Apollo, one of the largest private investment firms in the world and the largest private credit manager in the world as well. Marc Rowan, welcome to Icons and Ideas.
Thank you. Nothing better.
I'm very happy to have you here. I'm glad you stopped by on your way back to New York. I want to start with our audience because you do so many things at Apollo, but really known for building the enterprise with private credit and expanding for there. So many people are hearing about private credit in the news and hearing it's good and it's bad. And let's just start with what is private credit? Let's just explain private credit to our audience.
Well, let's start the easiest way. Anything that other than public credit. So what is private credit? It's everything. Think of everything that is on a bank's balance sheet. A mortgage between two parties is private. A loan to a business, that's private. A loan to an individual, that's private. Credit card debt, that's private. We're talking about the bulk of the credit, not a small subset of credit. And the reason it's confusing to people is sometimes the term private credit is used to refer to an activity called levered lending, which is a subset of private credit. But we're talking about a market overall that's some $40 trillion.
So then if we look at that whole market, what is the typical investor getting when they invest in, say, your flagship private credit fund? What's the core of it, the business that Apollo's in?
Well, I think you think of it in two different ways. There's investment grade private credit and there is below investment grade private credit. That is really the distinction that people look at as they think about investing in these markets. And I start from the user's point of view. Think about what we're doing in the world today. We're building next generation manufacturing, next generation infrastructure. We're building energy, we're building data centers. All of these things are complex and they're long dated. Who's going to finance all that? Mm-hmm. Well, now think about the choices. There are only two choices for credit anywhere in the world. Credit either comes from the banking system or from the investment marketplace. The banking system is great at some things, but a bank funds itself with deposits, which are short. The bank, therefore, is a great short-term lender, but not a great long-term lender for these kinds of projects. The public markets, if you want something that is 10 years cookie cutter straightforward, the public markets are by far the easiest place to go. If you want anything other than short or easy, you come to the private market. If you are an investment grade borrower, Intel, AB InBev, Air France, AT&T, and you want to do something unique, you come to a firm like Apollo, you express what you want, and generally we provide that flexibility for excess return per unit of risk. So when people invest in a flagship fund that's investment grade, they're looking for 100, 150 basis points more return than they otherwise would get in the public markets for the same ratings. No more complicated than that. When you move to the below investment grade, now you're talking about something that is senior secured first lien debt, but it is below investment grade. But last I looked, debt came ahead of equity. And so if long-term equity returns are in the 9 to 10% range, and you can earn today close to 9, 10% on first lien debt, you're just talking about a really good alternative to equity at a time when base rates are relatively high. Is there risk? There's always risk. But it is less risky than investing in equity and still offers the same types of return. So yes. I think those are how I think about the two choices.
And it's become an incredibly popular asset class. I think because of that, people look at this expected return of, depending on the profile of risk, of 9+%, they compare it to stocks, and even after the tax difference, you start to go on a risk-adjusted basis, it's just getting a ton of money. And you start to see the Wall Street Journal, a lot of reporters, places like that are very critical that people don't understand the risk and there's going to be a big problem. And they, when I talk to clients, I talk about, well, it's like saying bonds are safe. I mean, there's all kinds of publicly traded. There's a treasury, and there's a municipal, there's a corporate, then there's a junk bond. You pick what you want to do, and the risk reward will be there. Do you see private markets the same way? What do you think about all the critics?
It is exactly the same way. And unfortunately, most of our financial journalists don't really know that much about it. But you can buy the safest of safe investment grade or the junkiest of junk and everything in between. But for me, the way I think about this, and the reason it's so popular, is not that all of a sudden we discovered it or that we're the best managers anywhere in the world. When interest rates were zero, credit was not that attractive an investment. Right. Now that interest rates are higher, credit is a really attractive investment. And so I look at the world and where we are today. I ask a couple of really simple questions. Do I think rates are going to plummet? And I'm not talking about the short rate, I'm talking about long rates. I don't. Our firm doesn't. I think most of what we're doing today from a policy point of view has the potential to be inflationary. I know those words can be inflammatory, but the potential to be inflationary. Right. Therefore, I don't think rates are going to plummet. Right. Second, are valuations cheap? Valuations are not cheap by any historical standard. 3, do we have lots of unusual political, geopolitical, and economic risks? Yes, open the paper, read something every day. And so in a world where rates are likely to remain higher for longer, where valuations are high and we have risk, if I can reduce risk by moving to credit versus equity and achieve similar rates of return, that is risk reduction rather than risk accretion. And I think the popularity of private credit is best explained in the context of being able to earn a really good equity-like return without the equity-like volatility.
I agree. The financial press on it has just been so off, treating it like just one thing when it's in a whole bunch of different sub-asset classes.
But this is, it's actually the most important of the questions that I think we will talk about today. The entire notion of private markets is itself up for discussion because my career now is 41 years. 41 years ago, when I started, private was risky and public was safe. Mm-hmm. Private was 3 products: private equity, venture capital, and hedge funds. All 3 have a place in someone's portfolio, but all 3 have risk. And public were 8,000 public companies, diversified portfolios of stocks and bonds, a 60-40 portfolio where when equities fell, bonds accelerated. Now you fast forward to a new world, and private is no longer 3 products. Private now goes from AA to equity. It is just less liquid, but it is safe and risky. And if you look at public, public is not 8,000 public companies, it's 4,000 public companies on its way to 3,500 public companies. And everything is indexed and everything is correlated. But when people look at their portfolios and they own equity today, most people own it through S&P 500 indices. Do they own the US economy? No, they own 10 stocks. 10 stocks are 40% of the index, and most of their return over the past few years has been one company, NVIDIA. NVIDIA is now larger than the stock market of every country in the world other than Japan. And NVIDIA is a perfectly fine company, but the notion of equity investing was about diversified portfolios. We don't have that. Public markets are now safe and risky. And so private and public are converging. Private and public are going to continue to converge and go back and forth. And what we're going to see is private growing faster than public markets. And investors are going to invest in private markets, in my opinion, in the normal course of business, not just as a special opportunity and an alternative.
Yeah, I think we're seeing more and more of that. I do think that in the stock market, there's always an NVIDIA. It's maybe not that's bigger than every country stock market in the world, but it seems like there's always that stock that lifts up the S&P 500 returns, which is why you see so much big money. What I've observed in my career, our practice is half people that have accounts that are about an average of 25 million and a little more than half kind of the millionaire next door. And I've seen the ultra wealthy in the public, they've started to increase their exposure to private markets, especially private equity and private credit, vastly more than everything else. They've moved away from hedge funds there, at least in my experience. And they've really moved to indexing in the public markets because there always seems to be the high flyer. You catch that needle in the haystack that there's going to be an Enron or whatever in there, but it can only go down 100%. Right. But the ones that are going up can go up thousands of percent, as we've seen over and over, whether it's not just NVIDIA and Apple and Google, it's Monster Energy and Southwest Airlines and Build-A-Bear, these stocks that wind up performing amazingly well. So I've started to see the portfolios really move towards private credit, private equity, combined with a very tax-sensitive approach that's indexed on the...
So I think you said the key word, which is and. Yeah. I think that's the world we end up in. Yeah. We don't end up in public or private. We end up in public and private. Yeah. And for investors who are at the top end of sophistication, who are well advised, they will end up with 2 portfolios, a public portfolio and a private portfolio. and their public and private portfolio will serve different purposes. One will be beta and give them some amount of liquidity. The other will give them excess return and more diversification. Notice I haven't used the word risk, because I'm not sure that the risk of public and private is any different at this point.
Yeah, I think that there's a transparency difference, but I don't think there's a risk difference, especially now that so much is rated, and some of these private companies are so big, and the companies have such a long history with so many vintages.
It's even beyond that. When you look at the public companies today around the world, not just in the US, and you're the CFO of AB InBev, a large beer company, you have a choice. You want to build a new manufacturing facility. You can go to your banks, you can go to the bond market, or you can go to the private market. You used to have 2 choices, you now have 3 choices. I think we're going to see it ubiquitous. And I think this is going to become part of the lexicon of every financial advisor as they speak to their clients, talking about the difference between public and private. And I think we're going to see products that actually blur the lines between public and private. Whether it is an ETF that is 100% investment grade, public and private, that outperforms all the other ETFs, which is daily liquid, or it is the kind of interval funds and redeemable funds and evergreen funds that have been very popular over the past few years.
What do you think is the cause of this explosion in awareness and investment in private equity and private credit? I mean, it goes back to the 80s. You've been in the business for over 40 years. But really, after 08, 09, it started to gain some steam, and really since the last 6-7 years, it's emerging as something that people are demanding in their portfolios. What is happening in this timeline?
So look, if you look at history, and the 40 years of history is not for this podcast, but you get to 2008, all of the large private markets firms that are large today existed, and we were all the same size. We were all 40 billion of AUM. We're now 840 billion of AUM, and our competitive peer set has moved just as much. We grew the business more than 20 times. We've outgrown Microsoft and Google and Apple, which is kind of crazy in financial services. And most days I like to attribute that just to good management, but that would not be true. We had a number of factors. First factor was, after the financial crisis, we as a country and a world, we floored interest rates to 0. Think of all the people who had made promises predicated on higher rates. Whether you were a pension fund, an endowment, or any form of retirement vehicle, you massively needed to increase your exposure to private markets because it was your only source of return. The second thing we did is we changed the role of the banking system. The banking system was much more ubiquitous before the financial crisis. The world indicated that they wanted the banks to do less, which meant investors were going to do more. And so a lot of what we're seeing today of building the new economy is being done by the leading private markets firms, and the amount of investment that we're seeing is like nothing we've ever seen. I jokingly say sometimes we're spending all the money since the invention of fire in a decade. And the scale of it, and everything we're doing in the US, Europe wants and is in worse shape, and so I think we're going to see lots of growth in Europe. We also had the biggest factor, which is indexation and correlation. So if you think about how people invested in equity when they wanted excess returns, they use active management. And to your point, all your clients have gone to indexing. Well, now the market is 60 or 70% indexed, and active management has failed to beat the market 90% of the time for 20 years. I don't think the active managers have gotten any stupider. In fact, I think they're really smart. The problem is the structure of the market has changed, and it's very, very difficult for active managers in debt or equity to outperform the index. And so for those clients who are looking for above average performance, they've had to step away from public markets and go to private markets. Those are what I'd call the macro factors that have pushed private markets. And then on our side of the ledger, technology. When you, as a private markets investor in the year 2000 or 2001, wanted to invest with a firm like Apollo, we couldn't consolidate onto your brokerage statement. Your advisor would pull another sheet of paper out of a drawer and say, oh yes, your account is this, plus you own this thing in Apollo. It actually felt sketchy. The way we interacted with you was through paper. We would FedEx subscription documents back and forth. Technology has been a great leveler because it's made the experience of investing in private markets very similar to the investments in public markets. And I think we're going to see much more happen on the technology side.
Now, because of all this, you're seeing thousands of other entrants into the space. I mean, what do you think the consequences are of, there's Apollo and there's other big players, but now there's thousands of other private credit shops, really small, regional, localized, specialized. What does that mean for the industry? What do you think it means for the consumer?
Well, I start with the most common question I get by people who are knowledgeable is, what will happen with all the money that has come to this market? And I answer them in a really straightforward way. I liked levered lending 3 years ago better than I like it today. I liked NVIDIA 3 years ago better than I like it today. This is always a question of alternatives. And so I look at the alternatives available, and I come back to the discussion that I started with. Valuations are high. Interest rates are not likely to come down. U.S. economy is in very good shape, notwithstanding that it is moving to deceleration versus acceleration. You want to be here versus anywhere else. As a macro bet, I believe that credit is going to do just fine. And while we have lots of people who are in the private credit business, I just don't think they really matter. I think the scale players who are capable of providing sophisticated oversight, sophisticated underwriting, and sophisticated level of services are going to end up much larger. And that's what we've seen happening across the marketplace. Lots of players who are really not relevant for the vast majority of clients, and then a smaller handful of asset managers who have proven that they have the skill sets necessary to succeed. It's not different than what's happened in public markets.
What do you think about the liquidity conversation that's happening now? So it used to be like, hey, if I want to invest in private credit, private equity, and Apollo does a lot of things, infrastructure, real estate, that I was giving up liquidity and that I was going to get the liquidity premium, and because my money's tied up, I could expect a better return because you could be more patient, you could exit when you want. And now we're seeing the emergence of products that provide semi-liquidity or total liquidity. And do you think the investor is giving up return for that? Or do you think, how do you think about it? I mean, I don't understand all the implications of this, the partial liquidity, at least, that comes with some of these.
So, really interesting question, answered on a lot of different levels, and I do think an important conversation. So the first is, who are the right clients for private markets? Well, the right clients start with those who are wealthy enough to not need 100% of their money on Tuesday. Because markets, not just private markets, can be illiquid at times. The second is the other end of the spectrum, retirees, or people saving for retirement. Why does someone who's saving for 50 years in a 401k or in some form of retirement vehicle care about daily liquidity? They're paying for something that they don't need. So at one level, it starts with, who are the right people to be participating in the private markets generally? And I think there will be some amount of self-selection. But the more difficult conversation is to understand the world we live in. So in 2008, we made another series of important changes to the way financial markets work. We discouraged market making by financial institutions. In the equity market, 3 or 4 firms step forward to provide liquidity. And when I go and visit regulators now, I say, well, you know who the largest provider of liquidity is? And they say, well, of course, the New York Stock Exchange. And I'm like, no, Citadel. Citadel, Jane Street, Susquehanna, and Blue Crest. 4 names that most people have never heard are our providers of equity liquidity around the world. I think Citadel alone is between 30 and 40% of all our trading activity. That's incredible. A shock to people. Yeah. And then I go the other way. Who stepped in on the credit side to provide liquidity? And you hear the silence now? That is what we hear. No one stepped in. And so trading liquidity in fixed income is 10% of what it was in 2008, and the market's 3 times its size. Yes, we have a 30th of the liquidity. We just don't know that yet because we haven't had a crisis, other than the lead up to COVID. And in the lead up to COVID, we had a real crisis that the government had to step in through the Fed to liquefy our markets. And so the point I'm making, we have a perception that because something is public, it's liquid. On the equity side, that's true. On the credit side, including investment grade credit, that's not true. On average, it takes you 5 days to sell an investment grade corporate bond today. It's not clear to me that we will have significant liquidity differences between public investment grade and private investment grade over the next year. We already see a trading market for private investment grade that is building every month, and I believe will approach the public investment grade trading market, which is not to say great, because we're still going to be dealing with the notion that there's a tenth of the capital in the world to do this. So this whole notion of liquidity is actually getting better for investors in private markets. Now the question is, what happened to the illiquidity premium? I don't know that the premium, the way it's been expressed historically, really exists anymore, because I think private markets are becoming more liquid. So where does the excess return come from? I believe the excess return comes from origination. Think about what a traditional asset manager does.
This is totally the Apollo theme, by the way, right?
Yes. The nice thing is this is what we do, and we believe it, and we build a business around it.
I know it. It's a fascinating.
If you're a traditional asset manager, there is no amount of money that you can't accept, because you get to buy everything that's existed for 100 years. You will buy what exists. If you're Apollo or another private markets firm, the way we create value is by creating. We originate. We only get to grow as fast as we can create, so we will never be as big as the big public market firms. And by working with borrowers, by working with individuals, by working with corporations who need something other than what they can find in the public markets, we get for our investors excess return per unit of risk. And at its core, that's our job. If we're not offering investors excess return, we should not be in the conversation.
So it's interesting to hear you talk about this, because there is a perception like, hey, if my money's tied up a little bit, I have a higher expected return. Historically, that's been the case. You see that diminishing to zero, and that returns might come from leverage and the ability to buy at the right price, and the network of whom you might buy, and how you can, the different ways you can exit. And a small firm can't exit by taking something public, and Apollo can, but you have competitors. You have competitors that just basically take everything and go buy everything. I mean, they're big, some of the biggest private investment firms in the world, and they really don't follow the mantra that you guys have, which is that purchase price matters. So you see that, not just it matters, you see that as the number one key of delivering returns.
I think it is all about origination and the capacity to create excess return per unit of risk, and I think all of the firms are going to end up here, because you cannot do a good job for a short period of time for your clients, and brand will carry you, and history and legacy will carry you, but eventually you need to produce returns. We exist in the financial marketplace to produce excess return per unit of risk, and if we fail to do that, we fail to have a growing business. And as I joke with you to start, our business is in great shape. The only better business is your business. And the reason I say that is we're moving from a world that my favorite analogy is I think we lived in a 3-flavor ice cream world. We had vanilla and chocolate, stocks and bonds, and a little bit of strawberry, a little bit of private markets. And now we're more in Baskin Robbins, where there are many gradations of stocks, many gradations of bonds, and many gradations of private markets. And the journey that clients are on, they are not going to take alone. And so the value of advice is going way up to navigate a world which is more complicated but better for clients. And the opportunity that I see as the world of big asset managers commoditizes between index funds and daily liquid is there are big markets that exist that are not being served by the big asset managers. And so private credit is the one we're talking about today, and I think we're going to be doing private credit for a long time, driven by the fundamental of what we're building in the US in terms of next generation infrastructure, next generation manufacturing, what we're going to be building in Europe. The scale of it is unbelievable. And you see transactions like Meta, $30 billion. I think that is going to be the norm and not the one-off that we see. Maybe not at 30 billion, but very large established companies doing it. But I also envision a world in which other products are going to have primacy. Think about we've lived in a world where equity is either daily liquid or it's levered in private equity in a fund. What about everything in between that? What about the structured equity that yields 12% with good downside protection for a great company, but it's denominated as equity and it's private? Well, it's not public, it doesn't go into that bucket, and it's not 20% rate of return levered in a fund, so it doesn't go into that bucket. We call that business hybrid. Hybrid risk I think is one of the most interesting things going on in the investment market today and has for the last 15 years. And access to that by individuals, access to that by institutions has been very, very poor. And so we're talking about massively large markets that have yet to be fully penetrated because of the inefficiencies that exist in our marketplace.
You know, it's interesting when you talk about, at the beginning of this, the Apollo's value proposition being origination. And that did cause a shift in, when our due diligence team was researching and trying to select a certain fund, that created a big shift from another firm to Apollo with one of your funds, was the difference in origination and really believing that we could get better returns for our clients from that. When I look at the private market space, and I've had the opportunity to meet many people in your space that have had enormous success, and obviously many people in my space that have enormous success, and there's a lot of incredibly bright people. There's a lot of just kind of okay people, and there's people that really are not super impressive. But what we see over the last 10 years is everything works. Everything worked. And I do think there's going to come a day in my space, in your space, where people that are actually paying attention to what they're paying for things and how they're operating and what their clients are in, that there will be a differentiation. I think it will be a prolonged bear market that starts to expose some of the differentiation. We haven't really had that. I don't count the tariff thing that you blinked and it was over, and I don't count COVID where everyone thought they were going to die, and 6 weeks later the market was flooded with money by the Fed. I think we get another big long one, like 9/11 and the tech bubble combined, like two events that are prolonged, or an 08, 09, and there will be a tremendous separation in your space where origination is going to matter more than ever.
I believe that, and that's how we operate the firm. That's the whole notion of purchase price matters, which is not being taken by market forces on a given day and really sticking to fundamentals. But I'll go further than that. I actually think it's going to cause a vast acceleration of private markets. Because think about the concentration and the indexation in public markets. Mm-hmm. The trade has worked for a really long time. Prices are high by any historical measure. Mm-hmm. Having said that, performance has been good. What if performance is not good and it's really concentrated and correlated? All of a sudden, we've suspended belief for a period of time that 10 stocks can be 40% of the S&P and one stock can dominate, and that's good until it's not. Mm-hmm. And then everyone will say, well, how could I have lived with that amount of concentration? And we're going to realize that private markets are not just about excess return, they're about diversification. 80% of companies over 100 million in revenues are private. 80% of new employment is private. We're going to see much more growth in private markets than we are going to see in public markets, which does not mean that public markets are going to shrink. It just means private markets are going to grow faster. And I think if we get a setback that affects broad indices, that rotation is going to happen faster because people will be forced to confront some of the conundrums that exist in our public markets. And if we don't, the rotation is happening anyway. It's just going to happen more slowly. In the private markets, this is about choice. In a world that has been relatively benign, where interest rates have mostly cooperated over my 40-year career, where we haven't had a real recession in a long time, you're right. Most things have worked. And there's going to come a day when they don't work, and you're going to want to be partnered with people who think like principals, not like agents.
What do you think happens in the private credit market when we have the prolonged bear market and some of these thousands of little firms that are lending money fail or have funds that fail? Do you think it's going to cause, we talk about the public markets, there's the S&P 500, there's the mid-cap, there's the small-cap index, there's international emerging markets. Private credit, there's a whole bunch of things going on. If something goes wrong with some of these groups, which I think is going to be inevitable, do you think that will cause people to move away from those markets, or do you think it will cause them to be more selective about who they use in those markets?
I think both. Initially, it will cause people to move away. Everyone's reaction to a crisis is to clutch their money close to their chest, which is almost always the wrong reaction, because as you know, most return is made in periods of transition like this. But I do think over time, the fundamentals of private markets are so strong, we will see growth, and it's going to be concentrated in the hands of really good players. But this is now about choices. And every day we, and firms like ours, have a choice. Are we large company or are we small company? Are we senior secured only or are we second lien? Are we cash pay versus PIK? How tight are we on documentation? In a world that's been benign, it hasn't mattered so much. But the choices you make today are the choices that are going to determine performance. And this is where the personalities of the firms are going to be really, really important. And it's not just us who think this way. We are half of all of our AUM as principal. We're the largest owner of everything. And so the risk we're taking is a risk that we're prepared to bear as principal. When you think like a principal, you're thinking long term. You're not thinking about distributing something for the moment. It has not mattered for a period of time. I think it's going to matter. And running something on a sustainable basis is very important to us. Most of my net worth is tied up in Apollo and Apollo stock.
That's worked out.
It's been a nice place to be.
So we're talking about the expansion of the markets. I think we completely concur on that. What do you think about the several Wall Street Journal reporters keep referring to it as shadow banking, and we've got this whole banking system that's being created outside of the normal banking system, and we've had multiple crises in the public banking system, and now we think we're protecting that, but we're really shifting it to something that's less transparent. What's your response to that?
So I spent a lot of time responding to this, but because I spend a lot of time with regulators also, who also have the same interest. And the thing that I point out to them is the point of banking regulation in 2008 was to diminish the risk to the economy from a handful of very large institutions. Guess what? Dodd-Frank worked. Lending now is vast majority, 80-ish% outside of the banking system. And then I go into more detail. Every dollar that moves from the banking system to the investment marketplace is a deleveraging event. A bank is roughly 10 times levered. When a dollar moves from the banking system to the investment marketplace, it goes from levered to unlevered. That's a vast protection for the US economy. A bank funds itself with deposits, which are short term. The investment marketplace funds itself long term. The bank owes its clients back money at par. The investment manager, the investment client, accept the risk and reward that some things are going to be more than par and some things will be less than par. And so it is protective to the US system. And then the one that really I find very interesting, what is the average amount of investment grade on a bank balance sheet in the US? 60%. You look at a firm like ours, the average amount of investment grade is north of 80.
Interesting.
And so you start with a notion that, and it harkens back to a myth that we have, that private is risky and public is safe, or somehow private is risky and the banking system is safe. The reality is both are safe and risky. It depends on what you're doing with it. But the thing that regulators really are starting to understand is that people's investments in private credit, they're not selling treasuries to buy private credit. What they're doing is they're selling equities.
That's for sure true. Yes.
To buy private credit. And there's just not that understanding. When you move out of equity and into credit, you are de-risking on a personal basis your portfolio. Is it possible in a downside scenario that you will suffer losses in private credit? It is absolutely possible. But we think nothing of a stock that goes down 15 or 20%. We just take that as the normal course. This is just a choice of risk and reward at this point. So I do think the understanding is getting better. I do think the willingness of the financial press to really dig in and make these kinds of distinctions in education is low. But again, I come back to the value of advice is going up. And therefore, the transition from where we are in a 3-flavor ice cream world to a more complex world is only going to be done in an advice marketplace.
So it's interesting because we're talking about the advantages of reducing volatility, maybe improving return, all of the advantages of having a diversified portfolio, which we completely concur on, right? All of our clients, we like to recommend public and private and owner and lender across all of this spectrum. The idea of the laws that we have in this country to keep most people out of these is that we're protecting them. So historically, you have to have 5 million or more, be a qualified purchaser to do some of this. Some of these investments, you have 1 million or more, be a credit investor and do some of this. And we're seeing the great debate, which I guess is concluded now, about what about everybody else? Should everyone else be able to invest in this? And one group is saying, well, oh my God, if you let people invest in this, they're going to lose their money, and it's going to be terrible, and they're not prepared for it or educated enough for it. Another group is going, well, this isn't fair. Rich people are putting their money in these things and blocking everyone else from being able to invest in them. Now, President Trump, the Trump administration, basically powered through, allowing this in 401ks. I know that I don't know how involved you are in this specifically. I know you're very involved in many ways with all administrations. And so tell me your take on all of this, where you think this is going.
So 401k is the largest pool of money anywhere in the world. It's $12 to $13 trillion. People are in 401ks for 50 years. What are they invested in? Well, for the most part, they're invested in daily liquid index funds for 50 years. Mm-hmm. Why does that make any sense? And is it risky or not risky? Well, they're levered to 10 stocks that are 40% of the S&P and one stock that has performed. So long as that happens, it's been good. But that's not a 50-year investment. Everywhere in the world that 401k type investors have had access to private markets, they've achieved better returns. We've seen this in Australia, we've seen it in Chile, we've seen it in Israel, we've seen it in all different kinds of markets, and it's not 10 and 15% better off. You're talking about 50 and 100% better off in terms of outcomes. Does that mean that everyone is prepared to bear all private markets risk? No. In most of these other countries, they are advised. There's advice. That is going to have to be developed in the US. Right now, we're on a different journey for 401k. You think about what's happened in the retirement marketplace. We lived in a world of defined benefit where individuals and workers, they were very happy with that. They knew what their guaranteed lifetime income was. That wasn't so good for companies, particularly when they failed to meet the obligations. Mm-hmm. So we kind of threw everyone to the wolves into defined contribution, 401k. And we found out that no one makes any decisions in a 401k. Vast majority of investors never choose what to do. They're just defaulted into an outcome.
As a firm that manages hundreds of billions in 401k, I can tell you that's definitely true. Without advice, it's incredible. Most people will do nothing. The majority of people will never place a trade or do a single thing.
And that's across an industry. Mm-hmm. And now they're being offered access to an array of products that they've not had access to before. And with advice, I think they can have the same experience that everyone else. A point a year over 50 years is a massive amount of money to retirement. And I also think we're going to see solutions offered that are beyond investments. So think about, we went from a defined benefit world to a defined contribution world. I think we're going to go back to a defined benefit world where people are going to be able to buy guaranteed lifetime income. They'll be able to buy it in insurance format. They'll be able to buy it in annuity format. And they will be able to be on a journey where early in their career they own equities and more private investments and they're building wealth. Later in their careers, as they start thinking about retirement, they're moving themselves toward more fixed income, more predictable, and then they're moving toward some amount of guaranteed lifetime income. I think we're going to, for this group of people, a much better world. And yes, we need to see good conduct along the way. We need to see appropriate advice. We need to see appropriate rulemaking. But not giving them access to it has not served them well.
So I want to shift now. I mean, obviously, anyone listening to this knows you have total command over the subject matter of your field. You've got a reputation for that. I'm fascinated, having visited your headquarters a few times, met your number two and many, many people throughout the entire organization. I'm fascinated by the culture and how different it is to me than many other private investment shops I've walked into that kind of feel like some of them, like you would imagine, like it from them, just have much more of a hardcore culture.
The movie, the suit and tie, the serious briefcase.
Right. So, and here you are in khakis and a sweater. So tell me about I've read about you being described as having quiet power. How would you characterize yourself? Apollo, part of it's obviously you're a leader, you're great at what you've delivered the returns, right, for investors. But part of it has to be the culture you've built to attract and retain the talent. And what do you attribute it to?
Well, first, I think it's all about the culture. And this is the journey I'm sure you've been on in your career. You start your career, and the way you get ahead is you become a master of your craft. You're the best investor, you're the best advisor, you're the best everything. And that allows you to move to the next level. And the next level is you become a leader. You're not just doing your own book of business, but you're actually helping a group of people. And you do that for the next portion of your career. And then if you're really successful and really lucky and you've done something really good, you get the chance to scale. How do I now make it applicable on a societal level that is more important? And this is really the hard part, because you've gotten where you got as a result of being able to do things. My job now as CEO is to do nothing, because if I do it, I have to do it again. And so my only job is to make it easier for everyone else to do it. And so you think about like our asset management business, 3,500 people. We will bring in 500 people a year. Those 500 people are so happy to come to Apollo, and I have no doubt about their skill, but they're leaving institutions that they didn't like. Well, I don't want them to bring their bad habits with them. So we're spending a lot of time asking the question, what makes Apollo Apollo? What are the defining elements of our culture? How do we onboard you so we're not just teaching you your job, but we're giving you the unwritten rules there? And it's a really thought-provoking exercise, and it is the one that if we don't get right, we will actually screw this up, because the business takes care of itself. Private markets are growing. The investment process is great, but it is all about the people. So what do I think some of the attributes are? We're a challenge culture. See something, say something. You disagree, speak up. Intellectual insubordination as opposed to outright insubordination. We're also one firm, which means we have no walls amongst our various businesses. No one asks, what am I getting paid to help you? It's just an expectation of cross-firm, one firm, Apollo. And the final thing I will say, and I think one of the most important things, we have a principal mentality. When you are an agent, you're asking yourself, can I distribute this risk? Not, is it a good long-term investment, but is it okay right now? When you are a principal, you're thinking about the fundamentals of something because you know it's going to stick around for a really long period of time. And we only distribute that which we are a principal in. We don't distribute things that we don't already participate in side by side with our clients. It is the most fundamental. And then having the notion of being casual is not just about, first, I'm much more comfortable how I am, but also conducting yourself in a way where you treat people like people, where you deal with them in the moments that matter in their career like people, where you do not allow bureaucracy and rules to overtake the culture. Really important to what we do. And that's the challenge I know for you. It's certainly the challenge for me. It's where I spend most of my time. And if we get that piece right, and we point the firm in the right direction, which I call strategy, that's all I need to do. If I do anything, that's a bonus.
Well, you're running one of the biggest private shops in the world, but you do have hobbies. And I know a couple of them from reading about them, and it's restaurants. So I'm curious because, you know, everyone talks about the restaurant business as requiring a lot of time and attention, and it's very risky. So there must be a passion behind this.
So there is a passion, but it starts with people, it is called the restaurant business. And too often the people who are in the business start with just the restaurant side and forget about the business side. They're a great chef, or they have a great idea, or a great front of house. And I've been fortunate as a result of my hobbies to end up building and owning some great places where I get to do design and construction and concept, but then I have an amazing partner who runs the restaurant. Because once it opens, it's a restaurant. I don't know anything about running a restaurant, but we run the restaurant business. And we've been very, very successful at doing it. We now have 3 on the east end of Long Island, 2 under the Durier's brand, and 1 under the Lulu brand. We've opened in Riviera Maya in Mexico, in the same regions, going global,
just like
as the team gets better. And then, you know, in terms of outdoor challenge, I never swung a golf club until I was 50. I actually denigrated the sport, but who knew I was going to love it and be addicted?
Wow.
And I do love to mountain bike. I make sure to get out. I take my bike, I won't say every place, but most places I travel, do 3 or 4 big trips a year. This year so far, a ride in the Dominican Republic, the approach to Jerusalem, and Italy will be at some point in the fall and dovetail them with business trips. And I have yet to have any clients seriously injured who've come with me. So you're welcome to
Do you
give
bring
it
an
a
extra
shot.
bike with you, or what's your bike?
I have a specialized bike that I can lift with 2 fingers.
Oh wow,
It's a
okay,
really
great.
nice bike.
And your best ride so far?
I think the best ride so far is Morocco, the Atlas Mountains in Morocco.
Did you have like security with you while you were
No.
biking? No, it was
No, the nice thing about mountain biking is it's generally not security you're worried about. You're not worried about cars. You're not worried about what happens on the road. It's all about, your own stupidity. You're responsible for yourself out there, and it's just the best workout, a great way to see the outdoors. And I have done it with clients.
That'd be an interesting.
A few have gone down a little bit with a few bruises, but nothing serious.
Well, Mark, this was fantastic. Thanks for stopping by on your way home.
Thanks for having me. Really great. I totally appreciate it.